Hey, I'm Jonathan Wild, and we cover how to record the purchase and sale of treasury stock. When corporations repurchase their own stock from investors, this is called a stock buyback. A corporation's board of directors use stock buybacks to strengthen its stock price and boost certain financial ratios. The shares the corporation does buy back are called treasury stock. Treasury stock does not receive dividends and does not have voting rights. Okay, so now how do we account for treasury stock? There are a couple different ways, but in this segment, we will cover the cost method. Let's do an example. Assume a corporation has common stock with a $5 par value and 8,000 shares authorized, issued, and outstanding for a total of $40,000. It also reports $30,000 of retained earnings. And the corporation decides to buy back 500 shares at a price of $8 per share for $4,000. To record this entry, we debit treasury stock common for $4,000 and credit cash for $4,000. The treasury stock account is a contra equity account, meaning it reduces the amount of equity reported on the balance sheet. Total equity has now decreased by $4,000 to $66,000. Also, we report that 500 shares are in treasury and that retained earnings is partly restricted by the treasury stock purchase. Now, what happens though if the company eventually reissues and sells that treasury stock? Well, the accounting depends on if the treasury stock was sold above, below, or at cost. First, let's run through an example in which the treasury stock was reissued at cost. So assume the same corporation that repurchased shares at $8 per share now reissues 200 shares at the same $8 per share for $1,600 cash. To record this, we debit cash for $1,600 and credit treasury stock common for $1,600. Next, let's look at an example where treasury stock was sold above cost. So assume the same corporation that repurchased shares at $8 per share now reissues 100 shares at a higher $9 per share for $900 cash. To record this, we would debit cash for $900, credit treasury stock common for $800, and credit paid-in capital treasury stock for $100. Paid-in capital treasury stock is an equity account reported on the balance sheet. The $800 is computed as the $8 per share cost multiplied by 100 shares. The $100 is computed as the $1 per share price increase above cost multiplied by 100 shares. Next, let's look at an example where treasury stock was sold below cost. So assume the same corporation that repurchased shares at $8 per share now reissues 50 shares at a lower $7 per share for $350 cash. To record this, we would debit cash for $350, debit paid-in capital treasury stock for $50, and credit treasury stock common for $400. The $50 is computed as the $1 per share price decrease below cost multiplied by 50 shares. The $400 is computed as the $8 per share cost multiplied by 50 shares. So again, accounting for treasury stock depends on if it was resold above, below, or at cost.